Hey everyone, it's Lance and welcome back to the channel. Today we're diving deep into the world of Forex, and no, I'm not talking about getting rich quick schemes. We're going to break down, step by step, how to actually understand and utilize Forex signals to make informed trading decisions, just like the pros. Now, I gotta be honest with you, this isn't some magic trick, it takes work. But if you're willing to put in the effort, understanding Forex signals can be a total game changer for your investment strategy. Over the next 10 chapters, we're covering everything from the absolute basics of what Forex signals even are, to choosing the right sources and analyzing them effectively. This is your one-stop shop to becoming a Forex signal master. So, if you're ready to level up your trading game and finally start making those smart, calculated moves, grab your notebooks because class is officially in session. All right, before we get ahead of ourselves, let's start with the foundation. What exactly Forex signals? In the simplest terms, they're like little hints or alerts that suggest potential trading opportunities in the foreign exchange market. Think of it like having a friend in the know, giving you a heads up on which currencies are likely to move and when. These signals can come from a bunch of different places. Some are based on cold, hard data and technical analysis, like looking at charts, patterns and indicators, kind of like reading between the lines of a stock's performance. Others are derived from fundamental analysis, which is a fancy way of saying looking at the bigger picture of the global economy. We're talking things like interest rates, economic reports, even political events, all that juicy stuff that can cause ripples in the currency market. And then there are signals that combine both approaches, because why not have the best of both worlds, right? Now, the cool thing about Forex signals is that they can be generated by algorithms and fancy software, or even by experienced traders who know their stuff. But remember, not all signals are created equal, and that's what we're going to unpack throughout this entire guide. So, whether you're just starting out or you've been dabbling in Forex for a while, understanding the different types of Forex signals is the first crucial step to making them work for you. Stick with me and we'll make sure you choose the right signals for your investment goals. Okay, so now that you're familiar with the different types of Forex signals out there, the next big question is, where do you actually these signals? And more importantly, how do you know which ones are legit? Just like anything else in the world of investing, there are tons of so-called gurus and experts promising you the moon and the stars. But let's be real, the last thing you want to do is base your hard-earned money on some shady signal provider with zero credibility. So how do you separate the wheat from the chaff? Well, first things first, do your homework. Look for reputable signal providers or services with a proven track record. Don't just take their word for it, dig a little deeper. Check out independent reviews, see what other traders are saying, and most importantly, look for verified trading history and performance statistics. Remember, transparency is key. A legitimate signal provider should have no problem backing up their claims with real data. And here's a pro tip. Don't be afraid to shop around and compare different providers before you commit. All right, let's talk tech. Technical analysis is all about using charts, patterns and indicators to predict future price movements. It's like being a detective looking for clues to solve the mystery of where the market is headed. One of the most common tools in technical analysis is the use of indicators. These are like little mathematical formulas that help you identify trends, momentum and potential reversals. Some popular indicators include moving averages, which smooth out price data, the RSI, which measures the strength of price movements, and the MACD, which helps identify changes in trend direction. But it's not just about the indicators, you also want to keep an eye out for chart patterns. These are recurring formations that can give you insights into market sentiment. Some classic patterns include head and shoulders, double tops, bottoms and triangles. Don't forget about trend lines and channels. These are lines that you draw on your charts to connect swing highs and lows, giving you a visual representation of the overall market trend. By identifying these trends, you can anticipate potential breakouts or reversals. Technical analysis is a powerful tool for any Forex trader, but it does take practice and patience. So spend some time learning the different indicators, patterns and techniques, and remember, the more you practice, the better you'll become at reading the charts. Let's shift gears now and talk about fundamental analysis. This approach is all about understanding the underlying factors that drive currency movements. Think of it like looking at the big picture of the global economy. One crucial aspect of fundamental analysis is keeping an eye on key economic indicators. These are statistics that reflect the health of an economy, such as GDP growth, employment data, inflation rates, and interest rate decisions. By analyzing these indicators, you can gauge the strength of a particular currency. But it's not just about the numbers, you also need to stay informed about major news events and geopolitical developments. Political instability, natural disasters, or even a change in government policy can all have a significant impact on currency values. Central banks play a crucial role in the Forex market, so it's essential to understand their monetary policies. Pay attention to interest rate decisions, inflation targets, and any announcements or speeches by central bank officials. These can provide valuable insights into future currency movements. Fundamental analysis requires you to stay informed about global events and economic trends. It's like being a global citizen, keeping your finger on the pulse of the world. Okay, so you've got your signals, but how do you know if they're actually worth trading? That's where signal validation comes in. It's like double-checking your work before you hit that submit button. One of the best ways to validate a signal is to look for confluence. This means checking if multiple indicators or signals are pointing in the same direction. For example, if you see a bullish signal from a technical indicator and it's also supported by positive economic news, that's a good sign. Another crucial aspect of signal validation is assessing the risk-reward ratio. This is the potential profit you stand to gain versus the potential loss you're willing to risk on a trade. A good rule of thumb is to look for trades with a risk-reward ratio of at least 1 to 2, meaning you're aiming to make twice as much as you're risking. Don't forget to consider your overall risk management strategy. Determine how much of your capital you're comfortable risking on any given trade, and set stop-loss orders to limit your potential losses. Validating your signals is all about being thorough and making sure you're not jumping into a trade blindly. It's about making informed decisions based on solid evidence. All right, before you risk your hard-earned money on any Forex signal, it's crucial to put it to the test. That's where back-testing and forward testing come in. Think of it like taking a car for a test drive before you buy it. Backtesting involves applying your signals to historical data to see how they would have performed in the past. You can use trading platforms or software that allow you to simulate trades based on historical price movements. This helps you identify any weaknesses or flaws in your strategy. Forward testing, on the other hand, involves testing your signals in real-time market conditions. You can do this by using a demo account or by starting with small position sizes. This allows you to see how your signals perform in live trading without risking significant capital. Both backtesting and forward testing are essential steps in the signal validation process. They help you gain confidence in your strategy and identify any areas for improvement. Remember, past performance is not necessarily indicative of future results, but it can give you valuable insights. Chapter 7. Now that you've got your signals validated and tested, it's time to create a solid trading plan. Think of this as your roadmap to success in the Forex market. Your trading plan should outline your entry and exit rules based on your chosen signals. It should define your risk management strategy, including stop-loss orders, position sizing, and overall risk tolerance. It's like having a set of rules to follow so you don't make impulsive decisions based on emotions. Having a well-defined trading plan helps you stay disciplined and consistent, which is crucial for long-term success in Forex trading. It prevents you from making emotional decisions based on fear or greed. Review your trading plan regularly and make adjustments as needed based on your performance and changing market conditions. It's not set in stone, it's a living document that evolves with your trading journey. Chapter 8. In the world of Forex trading, staying adaptable is key. It's not enough to just set and forget your trading strategy. You need to constantly monitor its performance and make adjustments as needed. Regularly review your trading journal or log to track your wins and losses. Identify patterns and analyze your decision-making process. This helps you understand what's working and what's not. Pay attention to the accuracy of your signals. Are they consistently leading to profitable trades, or are they often generating false signals? If you notice a decline in signal accuracy, it might be time to re-evaluate your signal provider or adjust your strategy. The Forex market is dynamic and constantly evolving. What worked yesterday might not work tomorrow, so stay flexible, adapt to changing market conditions, and don't be afraid to make adjustments to your strategy. Chapter 9. All right, let's talk tools of the trade. In today's digital age, there are some amazing tools and platforms available to help you analyze signals and make informed trading decisions. One of the most popular platforms is MetaTrader 4 or 5, also known as MT4/5. It's like the Swiss Army knife of Forex trading platforms, offering advanced charting tools, technical indicators, and even the ability to automate your trades. Another great option is TradingView, which is a cloud-based charting platform that provides a wide range of tools and features for technical analysis. It's known for its user-friendly interface and social networking features, allowing you to connect with other traders. If you prefer a more hands-off approach to trading, you can also explore automated trading systems or expert advisors, commonly referred to as EAs. These are computer programs that can execute trades on your behalf based on predefined rules and signals. Don't be afraid to experiment with different tools and platforms to find what works best for you. The right tools can save you time, enhance your analysis, and ultimately improve your trading results. Chapter 10. Last but not least, remember that the world of Forex trading is constantly evolving. There are always new techniques to learn, strategies to explore, and tools to discover. Make it a habit to stay updated on the latest market trends, news events, and economic indicators. Subscribe to reputable financial news sources, follow industry experts, and join trading communities to exchange ideas and insights. Consider expanding your knowledge by reading books, attending webinars, or taking online courses on Forex trading, technical analysis, and risk management. The more you learn, the better equipped you'll be to navigate the complexities of the market. Remember, Forex trading is a journey, not a destination. There's always something new to learn, and the more you invest in your education, the greater your chances of success. So, there you have it, our comprehensive guide to mastering Forex signals. By combining technical and fundamental analysis, using reliable signals, and continually refining your approach, you can make more informed and effective trading decisions in the Forex market. Remember, Forex trading involves risk, and it's essential to trade responsibly and within your means. Never invest more than you can afford to lose. Now, if you found this video helpful, be sure to give it a thumbs up and subscribe to the channel for more insightful content just like this. And don't forget to hit that notification bell so you don't miss out on any future videos. Until next time, happy trading.